everyone. Good afternoon. Am I audible? Please give me a quick confirmation through the chat box. All right. Thank you, guys. All right. Okay. So, good evening, everyone. Good evening once again, and welcome to our grand webinar, day 2 for September 2026 attempt. What we have already finished now is our webinar day 1, which was conducted yesterday. I took you all through the acquisition scenarios of change in group structure. We did 4 scenarios for step acquisitions. We did 4 scenarios for direct acquisition. And it was a very important session. So, all those who have missed it, please watch. Extremely important session. It's a 3-hour session, but it will give you major control over change in group structure topic. Is it soft? Is it for Raghavina only or is it for everyone? Is my voice soft? Okay, great. Raghavina, try to fix your speaker here. All right. So anyway, by now the past paper of ACCA has been released. The recent past paper by ACCA body has been released, which is the June 2026 paper. So for me, nothing better than to drill a June 2026 paper consolidation question in our grand webinar. Like I told you, it was going to be a marathon of consolidation only these 2 days. So we covered 8 scenarios yesterday. Today we will cover a full length 30-mark question from the most recent release by the ACCA body. Most recent release by the ACCA body. That's right. So I would want you all to come to your practice platform and go to your June 2026 paper. It got released yesterday. So please open that. So I'm going to click browse available exams, going to click SBR. We're going to click international. We're going to put it on no category, or we can put it on past exam category, better. And then we look for September 2026 paper. Sorry, not September, June 2026 paper. September is what you all are going to give. So June 2026 paper is a recent past paper which has been released. So you're going to click assign to yourself. For me, it's already assigned, so it will not let me assign it again. So what I'll do is I'll click now view assignments. And in my assignments, I should be able to view this paper. The June, yeah, that's right. I have a mark exam and then I have a start exam. So I want to start my June 2026 paper. So again, you have to view the whole screen, otherwise they will not allow you to go to the next page. Remember this on the exam day. If you get stuck, remember to scroll up, down, right, left, and then you'll be allowed to go to the next screen. So at this point, guys, I should be clearly audible. My screen should be clearly visible. I should be visible as well. If there's any glitch in any of these 3, please let me know. What I'd do is instead of solving this on a Microsoft Word and a Microsoft Excel, I will choose to solve this on the exam workspace only, the constructed response, so that we can get an idea, you can get an idea of how to use the word processor and spreadsheet. Okay. So many times I do get feedback that we were not prepared to use the word processor and spreadsheet, which is the exam style. We were so used to the Microsoft version that we found it difficult to use the exam style. Also, only little space is available in the screen. We are so not used to, doing that. So again, my requested at least 1 to 2 papers should be cracked in this constructed response workspace. Okay, at least 1 to 2 papers. So I have a message from one of the students that the student cannot hear me. Is that the case with everyone? I don't think so. Otherwise, you all would have raised the issue by now. Uh, okay, perfect. We're going to proceed. I think the problem is with the student. So it's okay. I've replied the student anyway. All right. So we're going to start with the background, read the requirement, and cater the requirement one by one. And this is also a change in group structure question. Yeah, I mean, I was waiting for both the sessions to get over. So I've not sent yesterday's handouts as well. So yesterday and today's I'll be sending together. Okay, day one and day two. Global group 5, right? Okay, because I myself am not in all the global groups. Okay. Anyway, so we will proceed. I'll read the background requirement and we'll cater the exhibit one by one. And I just was trying to tell you that we catered change in group structure scenarios yesterday. This question also has a change in group structure. So you will see now when you see a fresh question, like a recent question, you will see how much control you have, okay, over it. Of course, not 100%, but definitely you will feel much better now when you do this. So, Shibe is the parent, Shibe company is the parent of Shibe Group, which operates in the textile industry. All group companies prepare financial statements in accordance with IFRS accounting standards. The financial year end is the 31st December 20x5, which is your calendar year end. Okay. It operates in the textile industry. Fine. The following exhibits available on the left hand side of the screen provide information relevant to the question. Acquisition of Lodge Company provides information about the purchases of equity shares in Lodge. Okay, so that this could be an acquisition of an associate, or this could be a subsidiary acquisition. We don't know just by reading the title of the exhibit. We'll only know when we get into the scenario. Second is sale of shares in Bohr Company, provides information about the sale of equity shares in Bohr Company. Great. So we will also learn a disposal scenario. Okay. And by the way, if time permits, then once I'm done with this question, I'll take 2 to 3 disposal scenarios, two rather disposal scenarios, like how I did acquisition scenario yesterday. Two, I'll just take disposal scenarios as well. Post this question is done. Okay. Drafts consolidated statement of financial position. The draft consolidated statement of financial position for Shibe Group as at 31st December 20x5. This information should be used to answer the question requirements within the chosen response options. Um, Now, going back to the requirement of it. Using exhibit 1, explain with calculation. So you know that you now, when you see your constructed response questions, when you have it, it's not coming without the explain bit. It is always coming calculations with explanation. So explain with calculations the correct accounting treatment of the investments in Lodge in the consolidated financial statements. So investment in Lodge in the CFS. This needs to be explain with calculations. For the year ended 31st December 20x5, your answer should include any calculation of goodwill. So you have to do a calculation of goodwill as well, arising on 31st December 20x5. So you have to get into the detail of the investment calculation in the consolidated financial statements and the calculation of goodwill, both. And this is worth a 13 marks. So this is a major mark allocation here. Okay. A good chunk of mark right in the first exhibit. Then coming to the second exhibit, they are saying using exhibit 2, explain with calculations how the sale of shares of Bohr on 31st 20x5 should be accounted for, and how this should be corrected in the CFS for the year ended. So I will read this requirement once again once I'm done with A. For me, they don't look interlinked or interconnected. It's a totally different entity that they're talking about in exhibit 2. Okay. Now coming to exhibit C, using exhibits 1 and 2 and your previous answers, adjust the pre-populated spreadsheet response option to correct the draft consolidated statement of financial position as of 31st December 20x5. And this is worth a 10 mark. So you all know that when I'm going to do the first exhibit, I will not wait for finishing the second exhibit and then coming to the third exhibit. When I'll be catering these 13 marks, whatever adjustments were there to be done in the pre-populated, I will be doing parallelly. Okay, I'll be doing parallelly. So not just 13, I might end up grabbing, like, let's say, good a 20 mark chunk, right? Like there could be good 6, 7 adjustments coming out of this. I might end up grabbing not 13, but 20 mark chunk while I'm doing the first requirement itself. While I come to C, I'm actually already done with everything. I won't be doing it again. I'll be done with it. Okay. So that's the attempting style that is expected from y'all. Now, coming to acquisition of lodge. So, what I would do is, because there is explanation, there's calculation, there's quite stuff to do, I will put my requirement A over here and I will pull what the requirement was, or maybe just copy paste this exactly. Okay. And you want, you can break it into subheadings so that you don't forget the requirement. Okay. Correct accounting treatment of investments in lodge. Right. This is one of the things that you have to do. In CFS, you can write CFS. The other thing is your answer should also include any goodwill arising. Okay. So the goodwill also. Maybe it will be combined, maybe it will be separate explanation. I don't know. I'm just blocking space so that I don't forget the requirement, that there were two clear requirements out of this. Okay. Now let's proceed. So Shibe bought 30% of the equity shares of Lodge 6 years ago at a cost of 7.1 million. At this point, I don't know if it's a step acquisition because I have read this question, I am aware. But at this point, when you are sitting in the exam hall, for you, the exhibit title was only acquisition of investment or acquisition of shares in Lodge. It did not mention if it's a step acquisition or it's going to turn into a subsidiary. No. So for you, you know that at the start, okay, 30% shares taken in Lodge. Fine. 6 years ago at a cost of 7.1 million. Only if I knew that, okay, this is a step acquisition question, I would have already gotten done with the structure. You all recall the structure that we were doing yesterday, right? Your fair value of the shares acquired, add NCR less goodwill, and also consider your carrying value of the existing investment or carrying value of the associate and remeasurement gain or loss. You remember the yesterday's format that we were doing on and on and on? That same format I would get done with, but right now I don't know, so I will hold. Or you can quickly browse Shibe bought 30%, look for if there is any further purchase. I can see Shibe obtained control over Lodge by purchasing a further 45%. If you have identified this very quickly, then well and good, go to your spreadsheet and get done with the format for step acquisition, because you know that this exhibit is an acquisition, but is it a control subsidiary acquisition or an associate? You don't know. So you could go ahead and finish the structure of step acquisition. Okay. So this is requirement A, acquisition of large company. And they did say should include goodwill. That itself should act as an indication that, oh, if it's goodwill and if it's acquisition, then it for sure is a subsidiary acquisition. But starting with 30% means it's a step acquisition. Starting with 30% means it's a step acquisition. So, anyway, we will start fair value of the shares acquired, which is your purchase consideration, add NCI, less net worth. You know, this will give you your goodwill. But you know that you're missing on something, because when you do your fair value of shares acquired, that is the shares further acquired. NCI will be the remaining. What about the remaining percentage? Okay, for example, fair value of the shares acquired, when I see over here, how many are the further acquired? 45, right? NCI in this case is 45 plus 30 would become 50, 60, 75. So this is going to be a 25%. So when I remove net worth, try to see what, try to understand what I'm saying. I'm saying you're removing or you're comparing 75% with 100%. It's not a like to like comparison. So what is there, that remaining thing for that like to like comparison? Your existing investment. You have to compare also with existing investment. So carrying value of existing investment. Add remeasurement, gain or loss. So this together will form that remaining 25%. Okay, so I'm just going to remove these, sorry, percentages because they were just there for as an indication for you all. Anyway, now that they tell me that Shibo was bought 6 years ago for a cost of 7.1 million, the moment I read the 7.1 million, best is to go and put it in your format. 6 years ago, bought for 7.1 million, which means carrying value of existing investment at the acquisition date, at least the starting point of this is 7.1 million. This will increase. It being an associate will increase, but this would be the starting point of it. Okay. When, so you acquired it at a cost of 7.1 million when the carrying amount of Lord's net assets in its separate financial statement was 21.5 million. The carrying amount of net assets was 21.5 million. Okay. At this date, Lodge had equity share capital of 10 million and retain earning of 11.5 million. So the 21.5, the net asset split is given that the share capital was 10 and retain earning was 11.5. So 10 plus 11.5 together was your 21.5 Lord's net asset at the date when you acquired 30%. So right now, still I can't do anything with this information. This is the net worth when I was taking it as an associate. Think how this information can be helpful to me. This information can be helpful when I want to do equity accounting for associate. If associate is not going to be recorded like a cost in the individual or it's in the consolidated, anyway it has to get recorded as equity accounting. So when I have to do a equity accounting for it, it has to increase from its original cost to the carrying value at the date whenever it is required. So if you're talking about further acquisition, then the carrying value at that further acquisition date. So how is it going to change? How is the cost and the carrying value at the future date going to be different? In equity accounting, you will keep adding the profits deserved by associates. So to that cost, you will keep adding the profit. Okay. So that original 7.1 million will increase in the future. The net worth they are saying is 21.5. Now in the future, if they give me the net worth again, the difference in the two net worth will be because of profit. I will take a percentage of that profit to find the associate share. I'll take a percentage of that profit to find the associate share. Okay. Now, the 30% shareholding gave Shibe significant influence over Lord's financial and operating policy decisions. So they do declare that significant influence was achieved, which means it was an associate. The Shibe Group has accounted for its investment in Lodge as an associate in the draft consolidated financial statements for the year ended 31st December 20x5. So Shibe has accounted for it as an associate at the year ended 31st December 20x5. For them to account for that investment as an associate, is that right or wrong? If they're saying significant influence is achieved, is it right or wrong? It's right. It's right. This is not wrong. This treatment, what they've done is right. It's not wrong for them to treat it as an associate. Okay. Now, so if I go back to my requirement, they did ask me using Exhibit 1, explain with calculation the correct accounting treatment of investments in Lodge in the CFS for the year ended 31st December 20x5. Okay, so up until now, when 31st December 20x5 came until the time they had a 30% investment, it's fine. They were recording it like an associate. It's okay. Now, on 31st December 20x5, on this specific date itself, Shibe obtained control over Lorch by purchasing a further 45% of its equity shares. So, at this point, at this date, at this date, control was obtained. So, control was obtained, which means SEP acquisition took place. At this date, step acquisition took place. Okay, which date? 31st December. No accounting entries have been recognized in the draft consolidated financial statements in relation to this purchase. Wow. If they did take a 45%, a step acquisition had happened. Dynamics changed, things changed. But they are saying no accounting entries have been recognized in the draft consolidated financial statements in relation to this purchase, which means it was sitting like an associate only. So, first of all, tell me that when you went from a 30% to further acquiring a 40%, did this become a subsidiary for you? Yes or no? Did it become a subsidiary? Yes or no? Yes, it did. With the 75% also, it might not become a subsidiary if there is any additional information which is negating the control. But there is no additional information which is negating control. In fact, if there is any information which is discursive, is saying only in line with, yes, it's a subsidiary because they're using the word control also. So it's in line with, if there's any additional information, it's in line with it being a subsidiary. Okay. So no accounting entries have been recognized is the mistake. If you remember, we have heavily drilled this exercise that what should the right thing be, what is the error that has been done or what they have done in the consolidated financial statements. Once we identified it, then we made the correcting entry. Okay? So same thing, we identified the mistake that they have done, which means they have only accounted for it like an associate. That was right. But after that, they never went to accounting for it like a subsidiary. That was wrong. Okay. So all those who are getting confused that above we have written associate is right and then below we are saying that there is some error, understand one thing, that up until one point of time, till 31st December, that same date only, recording for it as an associate till the time 30% was there is right. But if the same date you have changed the shares and you've acquired further shares, then after that, a change in uh, measurement was also required. That change never happened. So, no accounting entries have been recognized for that change. That part is wrong. That part is wrong. I hope it's clear. Okay. Significant influence is for associate, control is for subsidiary. Significant influence means it's an associate, and control means it's a subsidiary. Okay. Now, the consideration transferred was made up of two parts, 1 million of Shibe's equity shares. Okay, so you remember heavily we have again drilled this yesterday that when we are going to make the payment, the purchase consideration or fair value of the shares acquired, that payment can happen in various forms. It could be shares, it could be direct cash, it could be deferred consideration, it could be contingent consideration. Here, it's in equity shares. 1 million of Shibe's equity shares. This is the way payment has been made. Transferred on 31st December, which had a fair value of 12.2 million. So this is share exchange worth 12.2 million. And a commitment to pay cash of 10 million on 31st December 2026. Shibe has an annual cost of capital of 6%. So after 1 year, you're going to pay cash of 10 million. Can you tell me which form of purchase consideration this is? First is very straightforward share exchange. This is share exchange. Okay, the second is what? Deferred. Deferred. If you delay the payment and it's not conditional payment, it's a guaranteed payment, but it's a delayed payment, then in the second scenario, this was a deferred payment. When you record the deferred payment, will you record it as is or you will record it at present value? Will you record it as is or will you record it at present value? You will record it at present value. Absolutely correct. So come to your fair value of shares acquired. I'm going to try something. I'm going to try a control X and a control V and see if it works. It worked. Great. Sometimes it doesn't. So be careful. Okay. If it doesn't, then you figure it out. There is also a way of doing control C, control V, meaning copy and paste. So when you do copy paste, you can delete the lines in between. I'll show you all what I'm trying to say. Sometimes this control X, control V doesn't work. It gets completely deleted when you do a control X. So what you can do is control C. I need two spaces. So I'm going to put my line here and I'm going to do a control V. It copied the same thing. I'll clear these lines from between. So I got these lines, right? So explore all the options that's available. You don't want to panic for silly reasons in the exam, okay? Anyway, fair value of the shares acquired. So I have a share exchange. And then I have deferred consideration. Share exchange was how much? 12.2 and cash was why is this red? And cash was 10 million divided by 1.06, the cost of capital. Why is it red? Okay. So I'll just show you all what I did over here. 10 divided by 1.06. Okay. So this I'm done. Just I'll put it further down. Guys, now it's really up to you how much parallel you want to go with the correction part, okay? See, while I'm doing this, I have already read the requirement that no accounting entry was passed. I already know that the share exchange has not been recorded, deferred consideration has not been recorded. I can go in the pre-populated and immediately record for the share exchange and deferred consideration, okay? Or you want, you can go via JE also, journal entry also. So first thing I want to understand from you all that you all want to go always via a JV or without JV. Just put with JV or journal entry, with a journal entry or without a journal entry. Put in the chat. What is more comfortable for you all? Why do I have so much mixed opinions? One second. 3, 4, 5, 6, 7, 8, 9, 10. Clearly, many people are writing with, so we'll go with only. So then if you want, we can parallelly, or I can parallelly show you that I have already identified this has been missed. If this has been missed to record as a share exchange and deferred consideration, when you will actually record the issue of share capital and share exchange in my correcting JV, where will it come? Where will it come? Debit side or credit side? Debit or credit? Credit. Right? So in my correcting JV, credit share capital, credit share premium. How much? They said 1 million. So 1 million into $1. 1. And share premium would be 1 million into the excess. So I think it's $11.1. If I'm making any silly error in typing, please bring to my notice. I remember it as being a 12.1 figure, or it's a 12.2 figure. So it's going to be 11.2 then. Right? And deferred consideration was also not recorded. So deferred consideration also being a liability will, in my correcting JV, come on the credit side only. Okay, till here we all are sorted. Now let's read further. A summary of Lord's separate separate finance statement of financial position as of 31st December 20x5 is shown below. So you have your subsidiaries, PPE, current assets, share capital, retained earning, non-current liability, and current liability. And this is at which date? This is at your 31st December 20x5. In fact, I need this information. Why do I need this information? Because they did not account for it like a subsidiary. If they did not account for it like a subsidiary, line by line adding of PPE, of current assets, of non-current liability, of current liability is required. So I'll have to do a line by line adding. Okay, I'll have to do a line by line adding of this. Second, there is equity portion given to me of 31st December. This one, equity portion. This information, share capital, retained earning is required. Why? because they were recording it like an associate. So I need to understand how much is it standing at, like standing right now as an associate. Carrying value of that investment should increase by the profit it's earning, right? Carrying value of the investment should increase by the profit it is earning. So if I have the equity of the step acquisition date, if I have the equity of when it became an associate, if I take the difference of the two and multiply it with the associate percentage, I'll get the profit it earned. So I'll show you all one shortcut. Some of you all will understand that, some of you all will not understand. Those who will not understand, I'll go in detail. I'll make a separate working for it. But why I want to show shortcut? For those who can do it quickly in one line, should be able to, have that option that, okay, it can be done in one line and finished off also. Carrying value of existing investment, when you were doing your step acquisition, starting point was 7.8, 7.1. Now I have to go to the profit. So I'm taking the equity being 26.5 minus the equity at start, which was a 21.5, into the 30%. This is how your carrying value of investment would grow by its profit share. So anyone who didn't understand this, can put your doubts in the chat box. Not that we didn't do something like this yesterday. We did this yesterday as well, of how to calculate the investment in associate. But still, if anyone has a doubt. Retained share capital and retained earning only the equity. I will. Don't worry. So for all those who are thinking that y'all don't want to go through the JV route, I will show you how we could have done without the JV also. Don't worry. So yeah, all those who wants to get an understanding of how this is done, I'm going to now do a dedicated working for this. Okay, I'm going to do a dedicated working for this. So this is going to come a little bit above. Wow. So you can see this. So working for investment in associate. Okay. Carrying value, or sorry, cost of investment. So which is your initial investment was, I think, a 7.1. Then share in profits earned. So how much are the profits earned? 26.5. For those who are asking me how I got the 26.5, look over here. Share capital and retain earnings, 10 and 16.5. So 26.5 less 21.5 into your 30%. Okay. So carrying value of associate at acquisition date. Is this understood by everyone, all those who had a doubt in this? It's yeah, even if you do that, that is, if you just take the retain earning difference, that is also still going to, I think, give you the same answer only. Because your share capital is 1010. So if you take your retain earning difference, 16.5 and 11.5, yes, that's also fine. You want, you can do that also, no problem. 16.5 and 11.5. Because they will also be very clear so many times that the net assets movement is only purely because of profits. So that's why you can take the net assets also. It's okay. So I hope everyone is clear till this point. Okay, you want, I can put here also 16.5, 11.5. So anyway, we're going to proceed from here. We have calculated our carrying value of existing investment. And now we'll proceed. So what I wanted from here is when I saw this, okay, that I got these two lines to measure my share in associate. I can also at the same point of time, because I'm aware that the PPE, current assets, and all of this has not been consolidated, quickly in my JE, make a correction and consolidate it. So debit PPE, debit current assets. How much is my debit PPE? 17.2. And current assets is how much? 24.3. Meanwhile, I will also add the liabilities NCL and CL. So liabilities is 8 and 7. Okay. This is because I'm already aware that they did not do any accounting like a subsidiary. So I'm already aware is why I'm doing. If I didn't have this piece of information while I was reading this, I wouldn't have been able to do, which is fine. Whenever I'll get that piece of information, I would have done it. It's okay. So proceeding. On 31st December 20x5, the fair value of the 30% shareholding in Lorch originally acquired by Shibe was 10.2 million. You'll remember that we have to conduct a fair value exercise for the existing shares. So carrying value of the existing shares is 8.6, but I need to take the fair value. Fair value is a 10.2 million. Fair value is a 10.2 million. Why is it not highlighting? Yeah, fair value is at 10.2 million. So I will take my fair value. How? I will take 10.2 less 8.6. So I got a remeasurement gain separate, carrying value separate. Combined, it is going to be 10.2 only. 6 is 12 and away 8, 9, 10. 10.2 only. Okay. You can also directly take a fair value. But if you directly take a fair value of 10.2 without all this, if the question requires detailed explanation on how the investment was from start to end, then you might miss on that. Now I have a very clear visibility. Okay, I can talk on this line, I can explain this line, I can talk about the remeasurement gain because it's right in front of me. But if I write directly the fair value, I can miss that information. Anyway, Joydeep, because how the associate will increase is because of the share in profits. 16.5 and 11.5 are the retained earnings figures. They are the retained earning figure. They are the profit figures. So if I would take net assets also, I would have been right. The whole share capital and retained earning together, because normally the net assets are only changing because of the profit. But if that's not clearly declared that net assets are changing only because of profits, we could go wrong. So is why, okay, fine, retain earning comparison. Just retain earning comparison. Okay. Fine. I hope Pramati this has helped. So let's go and read further. The Shibe Group measures NCI at acquisition at fair value. The fair value for 25% equity shareholding was 8 in Lodge was 8.1 million on 31st December 20x5. So the 25%, because NCI is 25%, that 25% is worth a 8.1 million, is worth a 8.1 million. And I'm interested in the NCI measurement, NCI fair value. So NCI fair value is 8.1 million. Okay, we have recorded for this as well. We have recorded for this as well. What I'll do is this I'll take in the outer column. When I have my fair value, this I will take in the outer column. further. Land purchased by Lodge for the construction of a new textile factory was carried at its cost 1.2 million. So some element was being carried at cost. And you know, at acquisition date, everything has to be brought to its fair value. So this was being carried at cost as at 31st December 2025. The land has planning permission for either industrial or residential use. So you can use it for commercial purpose, you can use for residential purpose. As at 31st December 20x5, the selling price of land, if sold for industrial purposes, was only 1.4 million. But if sold for the selling price of land, if sold for residential, was 2.1 million. So you can see that the fair value is different in the market, carrying value is different. But the fair value depends upon the purpose, how you're going to utilize it. Are you going to make an industrial use or are you going to make a residential use? Now you have two fair values that way. Okay, you have two fair values that way. Which fair value will you pick? Will you pick 1.4 or will you pick 2.1? 2.1. What is the logic? Why are we saying 2.1? What is that keyword which makes us select 2.1? From your IFRS 13 fair value chapter, which is that keyword which makes you select 2.1. Yes, highest and best use. The highest and best use. So this is the best use of it. Okay. So 2.1. So you know that this will affect my net worth. If it's carried as in my net worth as 1.2, and if I want to make it a 2.1, the difference I'll have to take. The fair value increase, I will have to take the difference. Okay. So in the net worth, whatever is the net worth, I will have this land, fair value increase in land. It will be a 2.1 less 1.2. Okay. So that's a 0.9 increase. And I'm towards the end of the exhibit. So now whatever is missing, I will fill that. Fill in the missing blank approach. What is missing? Carrying value of the existing I have done. I have done a remeasurement gain or loss. Fair value of shares acquired done. Share exchange deferred done. NCI done. Less net worth is missing. So at 31st December 20x5, the net worth is already given to me equity of 10 and 16.5. 10 and 16.5. So this is in total, including the land, 27.5, 27.4. Okay. So this is giving me a goodwill of 12.53. This is giving me a goodwill of 12.53. Just 1 second. Yep, this is fine. Okay. Now, any doubt in this calculation before I proceed? Before I proceed to completing the journal entry, because we are doing a step-by-step approach. We all are good here, right? Now, in terms of correction, you know that this was not accounted for like a, it was not accounted for like a subsidiary. It was accounted for like a associate. Okay. So it till 31st December 20x5, it accounted for it like an associate, which means that in its book, it must be at 8.6 already. This 1.6, the fair value remeasurement gain or loss, is it a part of it being an associate, or is this a part of it being as in this 1.6 as a element? Why did it come? Because it was associate, or because we did an activity of step acquisition? That's why that 1.6 has come in picture. It's part of that associate valuation, but why did it come in picture? If it was going to be in my books as an associate only, would you ever do a fair value check for this 8.6? That what is the fair value of this 8.6? Would you ever do it? No, you wouldn't. So this came in picture only because you wanted to acquire you wanted to acquire the entity as a subsidiary. So if they were doing the accounting as per associate, they must have just done till this part. They must have done just till this part. This they must have done rightly. What they must have not done is everything after that. Okay. So I will do one step for this remeasurement gain or loss also in my correcting JE. Okay. So one journal entry I'll pass for this as well. I knew it that it's going to annoy me. One journal entry I will do first to increase my investment in associate. So debit investment in associate because of the fair value remeasurement. This has happened. Credit GRE, group retain earning. So this is 1.6, 1.6. Okay, this is done. So this I pass the entry. Now we are going to check what all is missing. What all is missing. Okay, we already started on what all is missing, but we'll go now line by line. We already started with what all is missing and started passing the correcting, but we'll go line by line and see what is being missed. The fair value of the shares acquired, they did not record for the share issue. Share exchange deferred consideration, we already passed. Share exchange, we already passed. Why is my deferred consideration showing a 0? Be careful, yeah. Keep cross-checking your figures. Sometimes when you cut and paste down, I don't know why these glitches exist, but it does change figures sometimes. Okay, so this is what we have done. Already done by them. Done in JV. Just for your explanation purposes, I'm putting all this in such detail, okay? Done in JV, done in JV. The NCI. The NCI recording did we do in a JV? No, we didn't. So record for the NCI because they must have missed recording for the NCI as well. So record the NCI.
If I say your name, come to my Jangit, I do a Bengali speaking. Michael, Scott, Ahmed, Muhammad, Yusuf. Mary,
Guys, mute, mute, mute. Okay. The NCI, we just now did it in JV. No need to do all this in your exam. Just for demonstration purposes, I'm showing you, okay? Then you have the net worth less 27.4 and you have a fair value increase in land. So how do you take the net worth? The line by line adding you have to do. You have done the line by line adding of PPE. Sorry, you have done the line by line adding of PPE, current assets, current liability, non-current liability. That's going to be your net worth taking into account the net worth and the fair value increase in land. That is not clearly taken. So you will take a debit land. Debit land 0.9. Then what else remains? The goodwill itself, they must have not taken. So the goodwill itself, debit goodwill. So all this I have done it. Done in JV, done in JV, done in JV. Okay. So I have accounted for everything. Now, the next best thing is to check if the sum of the debits and credits match. Then you know that, okay, you have been on track and just quickly go and do it in your pre-populated. Okay, so there is something missing, right? If this is not matching, then there is something that's been missed. So what is that? Okay. Yeah, you are absolutely correct. We did not de-recognize the investment in associate. What has already been done by them is that it exists as an associate. But when I am doing the acquisition as a goodwill of a subsidiary, this element carrying value of the investment with the remeasurement gain or loss should have been eliminated. You all know the first rule, in fact, of consolidation is cancel investment in subsidiary. So that step is missing. So credit investment in that entity, right? So in that entity, which was being recorded as an associate. Yes, it's exactly tallying now. So what you have to do at this point is now just how many items are there? 4. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 items are there, and then 12 and 13 items rather are there, right? So you have to go and quickly adjust for all these. Mostly for every adjustment, the way it works is for every adjustment, there is a 1 mark there. So normally the adjustments are increasing beyond the mark allocation. So if I go and check, I think the mark allocation was only 10 marks, that too including the adjustments of exhibit 2. So we will end up maximizing our marks limit. We will end up maximizing our marks limit. That will happen. Okay. Yeah, I'm not going to take this up because the moment I take it up again, it's, making some figures zero. It's very annoying the way they are, it's very annoying. Like, why are their linkings not proper? But anyway, this is something that you will end up facing mostly in the exam day also. So be very careful when you cut, copy, paste things, okay? It's not as friendly as your Microsoft sheet. All right. So anyway, now what I'll do is I'll quickly go, instead of getting into the explanation part, which will attract marks, instead of getting into that, I will go to my pre-populated and start doing the adjustments. I feel like that's more crucial because that's quickly getting marked. That's just taking figures and putting, right? Versus the explanation part, you have to write, okay, and then get the marks. So again, you're going to frame sentence, you're going to think how to frame it. It will take time. So best is first go and adjust it in the pre-populated. So first adjustment of the pre-populated that I will do is the fair value of associate. Okay, anything relatable, put it. What was the fair value adjustment in the associate? It was 1.6, 1.6. So plus 1.6. Go to your retained earnings, do a plus 1.6. Then you are doing an acquisition of subsidiary, right? So come and do all these adjustments one by one. Debit goodwill 12.53. Debit goodwill 12.53. Okay, let's have a look at few of the debit items. The PP 17.2, current assets 24.3. 17.2 and current assets was, I think, 24.3. Yeah, it's 24.3 and land 0.9. 24.3 and land 0.9. Land 0.9. Okay. Next is share capital, share premium. So share capital 1 and share premium 11.2. So share capital 1, other components of equity will be used as share premium 11.2. Deferred consideration 9.43, NCL 8. Deferred consideration 9.43, NCL 8. Current liability 7, NCI 8.1. Current liability 7, NCI 8.1. The investment in associate removal, it's a credit investment in associate removal 10.2. Okay, now just do a check. See all the adjustments that you're passing over here. Do they equal the adjustments that you've passed on the liability side? This is 65.3. Sorry, I took, I think, equity also. 44.7. 44.7. Okay, so all your adjustments are in line. Okay, before I get into the explanation or the writing part of it, the descriptive part of it, till here, I hope everyone is good, right? Till here, I hope everyone is good. Anyone has a doubt here now as to what I did, how I did? I did the goodwill calculation, then I prepared a JV, and then I did the adjustments and pre-populated, right? Okay, so for those who want to have a way of doing it directly in the pre-populated, how you could go about it, okay? So what you could do is that when you have this part goodwill, when you're preparing for this, and when you already knew about this, that acquisition accounting, nothing had happened as a subsidiary. When you started identifying, right, the first thing that I think I remember we were filling was after the carrying value of investment in existing investment is the share exchange and deferred consideration. I knew that this was not recorded. Immediately, if you're not doing the JV method, immediately when I do the share exchange and deferred consideration, go to your pre-populated and in the share exchange and deferred consideration, add 12.2 and 9.43. Immediately go and do this. So you did this first. Okay. Then when you were reading, I think the NCI was a ready-made figure. NCI was a ready-made figure. It was written and then you just put it in place. So when you identified this was NCI and you know nothing has happened as a subsidiary accounting, go and add the 8.1 to the NCI directly in the pre-populated. Okay. Next. So after that, the next step, I believe, was the net worth. We identified, I think, the net worth, right? Or fair value increase in land. Net worth was the last step, I think, fair value increase in land. So when you identified that the fair value increase in land is so much amount, and again, they have not accounted for anything, next step, you could have gone in the financials and just added for the point nine, for the point nine. Okay. Then okay. Once you were done with these four items, the trick or the way you would have went about it is you would have come and done a line by line adjustment. Now come to the line by line adjustment. Carrying value of the existing investment. Okay, so this is something you are aware that they have correctly accounted for, but they did not eliminate for it. So you would have identified, okay, this line I need a cancellation. So you would have gone in the financials and done a negative 8.6 from the financials. Gone in the financials and done a negative 1.6 from the financials for the investment in that associate. This is done. This is done. Okay, net worth is missing. So you would have gone and at this point of time added the assets and liabilities line by line. Or even while reading the question, you would have done this. Okay. And as a result, when you would have finished line by line checking, when you would have taken the debit side and the credit side of the adjustment and taken a sum of each, it would have tallied. And that's when you know, okay, line by line, you've checked, it's correct. You have done a cross check. You've done a cross check by checking the totals of it, they both are right. So that would be a closure for you that, okay, you've done it properly. You have done it properly. Okay. Now, the other thing, guys, that once, okay, before I move into the next bit of it, anyone has any doubt still in the direct way when you go and directly do it on the pre-populated? Again, any doubt over there? Okay, great. So remember, the question requirement on the discursive side was correct accounting treatment of the investments in Lodge and the goodwill accounting, both, right? So when I'm talking about the correct treatment of investments in Lodge, I will explain this that the existing investment that was already recorded must have been uh, the original cost of investment plus the share in profit, right? However, because step acquisition took place, the fair value of the existing investment was required, and this led to a remeasurement gain of 1.6. So this piece was to be explained for correct accounting treatment, okay, of Lodge and CFS. Then the goodwill acquisition. So for the goodwill acquisition, we should have started explaining that because it's a step acquisition, the each step, each line that we see here would have required an explanation. Okay. So no need for forming any bullet points or framework and then start explaining this itself. This calculation itself acts as bullet points for us. Okay. 8.6 million. And how the 8.6 million? This is by adding the share of associates profits, share of associate in the profits to the original cost of investment. In the bracket you want, you can show this. Okay, how the 86.6 million came? You have given a working for it. Okay, here it is. So you explained the treatment. You explained the treatment that this is what it was. This is what was required for launch in CFS, it being an associate. Now, when you do the goodwill accounting, what was required? As the step acquisition for launch took place on 31st December 20x5, the existing investment was supposed to be revalued to fair value, which was, if I'm not wrong, 10.2. 10.2. 10.2 million. This this gave rise to a gain of 1.6 on remeasurement. In order to obtain the goodwill, this fair value, along with the fair value of the shares acquired and the fair value of NCI, was to be compared with the net worth. Okay, so I'm giving a very gist or a high level sentence explaining what this formula is, that we're comparing the fair value of the existing investment, fair value of the shares acquired, and the NCI along with the net worth. Okay, now in detail, we can go with the adjustments part of it. So, fair value of the shares acquired consisted of payment in the form of share exchange. This required an issue of share exchange worth 12.2 million, if I am not wrong. Yeah, 12.2 million. This required increase in share capital for the nominal part by 1 million and increase in premium by 11.2 for the premium part. The payment also consisted of deferred consideration. This was to be recorded at its present value of 9.43 million. None of the considerations were recorded by the entity. Therefore, the same was to be recorded in the equity and liability. Okay, so I'm done with the carrying value. I'm done with talking about the remeasurement. I'm done with the share exchange deferred. Now let's talk about NCI. The NCI at the acquisition date had a fair value of 8.1 million, and the same was to be recorded on the or in the equity side. Line by line adding of assets and liabilities was not performed. Hence, this was required in the financials. There was one item with a different fair value compared to the carrying value in its books. Land had a carrying value of 1.2 million, while the fair value in the books was 2.1 million. 2.1 million was considered because it was the best was considered, or 2.1 million was taken as fair value considering the land's highest and best use as per IFRS 13 fair value. This led to a remeasurement gain of 0.9 million, which increased the net worth. The comparison resulted in a goodwill of 12.53 million. Which was to be recorded on the asset side. So you can see that each line we have tried to explain, and that's our approach, and not to write big paragraphs on each line. Okay, each line which is there in my calculation, you can see almost 1 or 2 lines for that I have mentioned. So you are being sure that, okay, nothing is being missed from an explanation perspective. Okay. Yeah, unwinding is not done because it's already at the end of the year. That's right. So I hope that for this 13 mark requirement, this 13 mark requirement plus whatever adjustments we already did on the pre-populated would have attracted, like I said, another 7 to 10 mark. We have done a 20 mark requirement easily, 23 mark requirement easily. I hope you all are comfortable by this. Anyone has any doubt on the approach or anything over here? Okay. So now we'll move to the next requirement of this, the bit B of it. Using exhibit to explain with calculations. Again, you have a explain with calculations coming in picture. How the sale of shares of board on 31st December 2025 should have been accounted for. So now we're talking about sale of shares. And how this should be corrected in the consolidated financial statements for the year ended 31st December 2025. How it should be corrected, which means that there is a mistake. There is a mistake. Okay, you already are aware that there is a mistake. And this is worth a 7 mark. So let's read this now. So on 1st January 20x4, Shibe bought 90% of the $1.6 million one equity shares of board. So you brought 90% of the $1.6 million one equity shares. Okay. Fine. Shibe correctly reported the investment in Bor as a subsidiary in the consolidated financial statements. Okay. So correctly recorded as a subsidiary. Fine. At acquisition, it was determined that the fair value of a building owned by Bor exceeded its carrying amount in Bor's separate financial statements by 1 million. So there is a building whose carrying value in the books is different and the fair value in the books is different. And by how much it is different, the fair value is higher, but the carrying value by 1 million. So when you acquire a subsidiary, this net worth is important. So if there's any fair value change in the net worth, this is an important piece of information. Right now, I don't know where to use it because they did talk about acquisition. Till now, they did not talk about what kind of disposal it is. Okay. So I'm not able to put up a formula. Whether it's a, control to control scenario, whether it's a proper disposal where from subsidiary it's now just an investment or from associate it's just an investment. I don't know. I don't know. Okay. So as well, I'm not able to put up a formula yet. The building had a remaining useful life of 20 years at that date. The building has been correctly accounted for in the draft consolidated financial statements. The Shibe Group measured the NCI at acquisition at its fair value. Goodwill relating to Bor was correctly accounted for acquisition and recorded as 0.6 million. So goodwill at acquisition date was a 0.6 million. Great. This is your goodwill figure. Goodwill has not been impaired since 1st January 20x4. On 31st December 20x5, so after 2 years from acquisition, okay, your acquisition date is 1st January 20x4, and then we are talking about 2 years from 1st January 20x4 on 31st December 5. Shibe
Hello, ma'am. Hello. I'm not audible. Network got cut.
All right. Sorry, guys, for the interruption. I just lost my internet and then I tried joining, and I don't know why. I mean, there was some issue with the whole host part, also. I couldn't be the host, also. Anyway, so moving ahead, where were we? We were at our exhibit 2, Bore. And yeah, I was telling you that I think we were discussing that from a 90% to if you're going to dispose of 5%, it's just a control to control situation. It's not changing anything in terms of it's not going to stop becoming your subsidiary or any of that sort. So from 90%, if you're going to sell 5%, you're with 85%. And you all rightly told me that it's a control to control situation. Okay, it's a control to control situation. In this case, do you find a gain on disposal? No, you don't find a gain on disposal. It's like a positive or a negative movement in equity that you find, and there's no reporting of that positive or negative movement through P&L, not via P&L. It will get directly reported in the equity, mostly in the other components of equity. That's how you deal with a disposal or acquisition which is no change in control. Okay, which is no change in control. So now that I understood this, I'll put up a format for this. That okay, this is a control to control scenario. um and they're saying Shibi sold 5% for 0.5 million. So this is the cash in that's come. This is the cash in that's come. Okay. So let me go to my spreadsheet. I'll use the spreadsheet. I'll do a requirement to be. And this is disposal or not disposal, control to control situation. Okay. So cash in, deduct, compare it with decrease. No, not decrease. If cash is coming in and if you're selling 5% of shares, will it be an increase in NCI or decrease in NCI? Quickly in the chat box, guys. Increase in NCI or a decrease in NCI? It's going to be an increase in NCI. Okay. And this will give you a positive or a negative movement in the equity. So cash in, you could directly see the cash in. How much is the cash in? For a 0.5 million. This was your cash in. So I'll use blue for these figures. Okay, 0.5 million. So 0.5 million. Now, I have to find how much is the increase in NCI. I have to find out how much is the increase in NCI. So, how do I find the increase in NCI? I have to take 5% of what? I have to take 5% of what? Take 5% off. Take 5% of the net assets. And should that net assets include goodwill calculation or should it not include the goodwill? Should it include goodwill or should it not include the goodwill? 5% of net assets would be the NCI increase, but should it include? Yes, goodwill will be included. What is the reason? Why are you telling me goodwill should be included? Because there is a reason. So tell me what is the reason? Because NCI was measured using the fair value method. So if NCI was measured using fair value method, which means in goodwill, the contribution of NCI is there. That's why NCI measurement when you will do it will be net assets plus the goodwill as well. So net assets we will take goodwill. Okay. I'm taking it like a, separate working altogether, like within increase in NCI, I'm taking what are the elements that will come in. Okay. Also, one more thing. There was a item, okay, which had a different fair value compared to the carrying value. So, which means this is responsible for changing my carrying value, or this is responsible for changing my net assets. The net assets that you will calculate has one fair value adjustment, okay, has this one fair value adjustment of the building of the building. In the net assets, when you acquired, the building had a fair value 1 million high, but it also had a life of 20 years, which means that when you are going to consider that building worth in that net assets, it can't be full 1 million. It can't be full 1 million because it had a life of 20 years. 1 second here. It had a life of 20 years. So, what increase you will consider is 1 million into how many years have passed since this acquisition? Full of 14, full of 15. This is happening on the 15th, right? So only 18 years of life remains with this 1 million. So 1 million into 18 years. So whatever is this amount, this is going to be a 0.8 million, I think. This much is the increase to the net assets because of the fair value exercise of the building. If this has not been understood by all, you all can tell me and I will repeat it. Okay. And I will also do it as a adjustment in the
Ma'am,
Excel. At that time also it will get better. Yeah, Raghavina.
fair value is already included in the, this fair value increase is included in the statement, right?
No, it's not included. No, you will include it.
I have
Okay, I
said
will.
that building
Yeah,
construction has been taken.
I'll repeat it, Raghavina. 1 minute. Okay, I will repeat it. So now because it's required for everyone. After this, also, if you don't understand, ask me the specific doubt. No problem. Okay. Okay, I'm going to come to the scenario and show you all. At acquisition date, it was determined that the fair value of a building owned by Bohr exceeded its carrying amount in Bohr's separate financial statement by 1 million. Okay, the building had a remaining useful of life of 20 years. The building has been correctly accounted for in the draft consolidated financial statements. Now, what happens is that, and also one more thing, 1 minute. Yeah. What's happening is that you know that when you acquire a subsidiary company at acquisition date, you find the net worth, right? And that net worth, if it has everything at carrying value and if the fair value is same, no problem. But if the fair value in the market is different, if the fair value in the market is different, you have to incorporate for that fair value. Okay, you have to incorporate. So the net worth will change because of that. The net worth will change because of that. So this 1 million incorporation, they're saying in the draft consolidated financial statement has been done correctly. I think Raghavina, you're coming from here. That they're saying it's been correctly done. So net worth should include this. Okay. Let's look at where is the net worth given to us as a piece of information.
Only the
Right now, what
depreciation part is missing, I think so.
yeah, wait, Raghavini. Let me finish, then I'll clear it. Okay. Now, here I want the net assets, which is the net worth figure. Okay, I will want the adjustment to the net assets, which is the building, if it's not included. Now, where is the net assets figure over here? If you may identify, they are saying the retained earning balance reported in board's separate statement of financial position at this date was a 3.3 million. So from here, I am getting the net worth one element, which is the retained earnings. Okay. I also have the share capital up in the first line, which is 1.6 million of the equity shares of the board. So these net assets are going to be made up of the 1.6 million equity shares plus the 3.3 million retained earnings. Okay. Now, this net worth is not going to include the 1 million increase of building because this is the single entity financial statement. So, single entity financial statement might not have it. Might not have it. Okay. So, what we will do is we'll do a deliberate exercise to include this fair value of 1 million. So, what I'm going to do is, and fair value increase in building. So that's going to be a 1 million divided into 18 years divided by 20. Why into 18 divided by 20? Why am I not taking the full 1 million? Why am I doing it into 18 by 20? Because at the acquisition date, which was on 1st January 20x4, 1 million taking was correct. But now it's after 2 years from acquisition. So that building increase also got depreciated, no? That increase in the building also got depreciated. So this is the depreciated value of that 1 million. This is the depreciated value of that 1 million. Okay. So increase in NCI, how will I take it? First, I will understand that the net assets are 1.6 plus 3.3. The fair value increase in building is a 1 into 18 by 20. The goodwill is a figure of 0.5. No, sorry. The goodwill is a figure of, they have given us goodwill also, right? Yeah, as 0.6 million. And goodwill has not been impaired. Okay, so you can see that this is coming up to not 0.8 million. I said 0.8 million. It's actually coming to 0.9 million. When you take the depreciated increase of that 1 million, you're getting 0.9, not the full 1 million. Okay, that's a 100,000 reduction over here. Now, I will take a slice of this. I'll take a slice of this for increase in NCI. So, what is the slice of this? Sum of all of this into a 5%. Okay. Sum of this means, if you want, we will quickly check what is the sum coming up to. It's coming up to 6.4. So I'm just writing for your understanding. This was not required for you to write in the exam because you have already done a linking by formula. So you've done a 6.4 into 5% here. 6.4 into 5%. This, when compared with the cash in, will give you a positive movement in equity. Why positive movement in equity? Because the cash that
Ma'am,
is high. 1 second, Ragina, let me just
yeah,
finish. I will open the platform for any doubt. Okay. Once the cash that has come in is zero point 0.5 and the NCI increase that is happening is only a 0.32. The cash that is increasing is higher than the increase in my liability. I will call NCI liability. Now, don't get unnecessarily confused. Why am I calling NCI liability? NCI is what? There are shareholders who have investments in a particular organization. So that organization owes money to those shareholders. Those are the NCI. So that equity, the non-controlling interest, is also like a liability, like a liability. So for your explanation purpose, I'm trying to make it easy for you that the increase in cash is more than the increase in liability. So is this a positive movement or a negative movement for you all? It's a positive movement. Yes, it's a positive movement. So this is your positive movement that you will be recording in your OCE. Okay, just hold on, guys. I will open the platform for the doubts. Wait. Now, what went wrong? What went wrong? After this share sale, Shibe has still had control over Bohr, which is evident. The 0.5 million cash receipt was credited to goodwill in the draft consolidated statement of financial position. They're saying the cash receipt that they got, so there is a debit bank The credit leg, they put it in goodwill. The credit leg, they put it in goodwill, which means what they did. The wrong, or I would say what they did was debit bank 0.5 and credit goodwill. Was this correct to do a credit goodwill by them? Was this the right thing at all? Were they supposed to do a credit goodwill for this? No. What was they supposed to do? This is the wrong entry. What was the right entry? Debit bank 0.5 million. This is fine. This is correct. Credit was what? The NCI increase, the movement in NCI. The NCI is increasing by 320,000. And there is a movement in equity. So positive movement in equity, which will sit in your OCE of a 0.18. So this is my wrong entry. This is my correct entry. But what should I go and do in my pre-populated? Can I go and do this in my pre-populated? No. Can I do this? No. I have to do a correcting entry. So what is my correcting entry? I will reverse the wrong. I will reverse this goodwill. So I'll make this debit. And I will pass entry for what has been missed. So credit NCI and credit the positive movement in equity. So this was required. Now I will open the platform for doubts one by one. Okay, wait. Okay, now anyone who has a doubt will ask me the specific doubt, or if you just want me to repeat, I will repeat it. No problem. What is it, guys, that we want? Do you want me to repeat? Is there a specific doubt?
No,
Okay.
not repeat regarding that net assets. It's already recorded, right? The increase in fair value. So
Yeah.
the thing is, which is not recorded, is the depreciation part, right?
So you're right, Raghavina, to think on those lines that it is already recorded, no? But it is recorded where in the consolidated financial statements. When they were giving us the equity elements, they mentioned that the retained earnings balance reported in both separate financial statements. So I don't have the equity of consolidated. I have the equity of the single entity. So the share capital, the retained earning, plus the movement of plus the 1 million fair value increase. This is how I'm taking it. I
Okay,
don't
ma'am.
have the, yeah, that's why. That is the
I
change.
understand.
Yeah,
Okay, ma'am. Thank you.
no problem, dear. Sorry, guys. Y'all are absolutely not right. Sorry. Y'all are absolutely not right. What I'm trying to say is that y'all are saying goodwill is a debit element, no? So if you would want to treat goodwill, it would have been on the debit side. Okay. So understand one thing. What they said that the wrong entry that has been passed is that the credit element they have recorded is in goodwill. That's what they said. Let's go back to the scenario and see. If you can see here, and I will highlight what is wrong. The 0.5 million cash receipt was credited to goodwill. See, it was credited. They credited. So if I want to reverse the impact of this wrong thing done, so I have to reverse it, I will have to debit it. They have lowered the goodwill wrongly. I'll have to increase the goodwill. Has that been understood? Yes. They dropped the goodwill, we have to increase it. Okay, I'm going to repeat this entry now. Okay, I'm going to repeat this entry. What they said that the proceeds that you received in the bank was credited to goodwill. So you received proceeds debit bank. That was not wrong because they did not tell anything wrong about the debit part. They said credited to goodwill. So this part was wrong. This part was wrong. How will I correct it? I'll have to think what was the actual original correct entry. So original correct entry was debit bank and the movement was increase in NCI 0.32. So credit NCI 0.32 and that led to a positive movement in equity. So it's a credit item. It's a gain for me in the OC of 0.18 million. Okay, of 0.18 million or 180,000. So for me, when I'm doing my correcting entry, what is rightly done? This is rightly done. Don't bother about this. I don't have a striking off feature. Otherwise, in Excel, I would have. showed you. Strike off the bank part. I don't care because that's something they did rightly. What they did wrong is crediting goodwill. So if they did wrong crediting goodwill, if you want to reverse the impact, you will have to debit it. What they missed is completely the NCI and positive movement. So I'll have to pass an entry deliberately of credit in nature to recognize it. Has the correcting entry been understood by everyone? Mahadi, Mariam, Sana, Inya, Har Sirat. Has it been understood? All right, great. So this is what we have to explain what wrong they did, and it's a step acquisition. No, Mahadi, it's not at all required. Guys, it's not at all required from an exam perspective to show a wrong entry, a correct entry. In fact, even correcting entry is not required. Till the time pre-populated was not introduced, they would ask these scenarios for journal entry purpose only. What is the correcting JV? What is the but because now pre-populated us, they don't bother about you making the correcting JV. Why am I giving it? Is only for demonstration purposes. Only for demonstration purpose. Yeah, it could be heavy. No problem. Just repeat this question again a second time. Okay. Yes. Increase in NCI is equal to the percentage of shares sold. Absolutely correct. So anyway, now let's get into the discursive part of it. Requirement B. Wow. Why is it not going up? Yeah. How the sale of shares should have been accounted for and how this should have been corrected. So accounted and corrected. Okay. So the sale of shares in board was a control to control situation as the board company was still a subsidiary even after disposal of 5% shares. As a result, only the movement in equity should have been recorded along with the change in NCI. There would have been no gain or loss on disposal recorded in the PL. The proceeds of 0.5 million should be compared with the increase in NCI by 5%. The NCI increase will be calculated by taking 5% share of the net worth at disposal date along with goodwill and the fair value increase in land or PPE. This increase was, guys, mute your mics, please. 0.32 million, if I am not wrong. Yeah. This increase was 0.32 million. As the increase in cash or as a cash received is more than the increase in NCI, this results in a positive movement in equity of 0.18 million. However, Lodge has done incorrect accounting by treating it as a decrease in goodwill. Therefore, goodwill decrease should be reversed by 0.5 million, and the increase in NCI by 0.32 million should be recognized, along with the positive movement of 0.18 million should be recognized. Okay, here I'm not, again, like I said, not getting into the short structure of it first, like how I went in the other sums of amalgamation when I was showing you in the live class. Because like I said, these figures or these line item itself is acting as pointer for me. So it will become a double effort to write pointers and then to expand it. Okay, so now I have to do a correction in the pre-populated. So correction in the pre-populated would be,
Ma'am,
yes,
no need to explain regarding that net assets and such.
you can explain, but for me, I feel like for the kind of marks that are there,
Enough.
yeah,
It's
you would have
enough.
already touched the 7 mark. But if you want, you
Oh,
could have written it.
okay.
Okay.
Fine. Thank you.
We can write that the fair value increase that we're considering for the PP item is a depreciated increase for only 18 years, right? Because 2 years would have been depreciated. You want, you can add that line. Okay. Now, control to control, what is the correction that is required? We'll have to bring goodwill back by 0.5. You will have to increase the NCI, non-controlling interest, by 0.32. You will have to increase the movement in equity, a positive movement, by 0.8. So these are the adjustments that we are doing. Okay. Now you can have a total column over here, but really no marks for that. So you can stop here because marks are lying in this, not in the total column. If the cash is more than liability, it means that you are incurring a liability. Okay. NCI is actually equity, but I'm helping you relate with it. Okay. Because NCI is also, again, a payment towards the shareholders from a company point of view. So think it in that fashion that you got more money. Okay. You got more money, but the liability that has increased against it is less. So that gap is like again for you because someone is going to claim, for example, let's think of it in this way. Bank gave you a loan of 10 million. Okay. Gave you cash 10 million, but he's just going to record it as 9 million. So is that 1 million not like a gain for you? That they're not considering that 1 million, right? That 1 million difference would act like a gain for you because you're getting proceeds of 10 million, but in the books or the claim will only be of 9 million. So that 1 million difference is like again that the liability increase is not as much the cash increase is there, the proceeds that you're getting against it. It's not like a share premium. I wouldn't say share premium. It wouldn't be a right comparison. But it's like you're incurring a liability, and against that, so when do you incur a liability? Let's say many scenarios where you incur a liability, but you also incur a liability when you have received money and you have not performed against it, or it's like a loan and you have to repay it in the future. So what is recorded in the books as a liability is only a 9 million. What you're getting is 10 million. Okay, they are not recording it as 10 million, but so that 1 million difference is a gain, no? So same thing here, you're getting proceeds of a higher amount, but the liabilities of a shorter figure, smaller figure. Is that understood, Minzu? Is that understood, dear? Okay, fine. So with this, we come to an end to the first question of consolidation of groups of the March June 2026 paper. We're going to take a 15-minute break and then continue with the some of the one or two disposal scenarios that I want to cover. And with that, we will end today's session. Okay, so you can put a 15-minute timer. And put a 15-minute timer. Okay, put a 15-minute timer. Other parts is done, no dear. The other part, guys, would be using exhibit 1, 2, and your 2 and your previous answer are just the pre-populated. While you were doing the 2, you did the pre-populated already. So this question is done. Okay, this question is done. All right, guys, please come back. The break is over. Okay. So, Raghavina, regarding the remaining questions of our June 2026 past papers, I will try to do that with this batch, but not in this webinar. This webinar, my focus is still um, very much consolidation only. Okay. Yesterday we finished these 8 scenarios. I'm still trying to cover more scenarios. So, disposal, we will be covering banana and Ashanti today. There are coming more sessions with this batch. Like we have practice sessions, we have mock, 50-mark mock, 100-mark mock. So I don't want to give details of how I plan to cover it, but I do plan to cover the June 2026 paper. Okay. Now coming to A3, disposal, where disposal could be a disposal where it's from a subsidiary to subsidiary, which is a control to control situation. It could be a subsidiary to associate. It could be an subsidiary to financial instrument. It could be an associate to a financial instrument, right? The disposal could lead to any scenario. So we look at banana Ashanti. Today also we did rather, I would say, a scenario which was disposal and which was a control to control situation. So we're going to look at some more of these. I'm going to require, I'll probably need our study text here, section C kit now. So yeah. Okay. So I'm going to go to Ashanti. Okay, Ashanti is the last question on this. Ashanti was, by the way, a PL question. Okay, so you have defined benefit, financial asset investments, Bookem acquisition. There is a disposal, once again, defined financial asset can provide some further information. Equity investment. Okay, let me just browse through it quickly. Okay, I'm just figuring it out because there is some linkage in different exhibits. So I just want to make sure that I read the correct exhibits, even if there is a linkage. Yeah, I know it's Bookham, but there is information flowing in different exhibits. Now, if it's going to cover 3 to 4 exhibits, I wouldn't want to, get into it because it would mean like reading the whole question. Don't want to target that right now. There's a very specific piece of Ashanti that I wanted to cater with y'all, and it was important to show y'all also. One second. Okay, and then this was recorded. Okay, kind of the purchase. Measure the investment. Okay, so now I'll just give you all the background of Bookham first. Okay, now Bookham is a exhibit in your Ashanti company question, and when you dispose of a share, okay, if it was a subsidiary and if you dispose of a share, and if it's just a small slice, like in this scenario, in this specific scenario, you had acquired 70% of the equity shares of Bookham. Okay, you had acquired 70% of the equity shares of Bookham. What you ended up selling is a 10%. Ashanti had disposed of a 10%. Don't worry. Even if you're not reading through it, I'm explaining all the parts which is required right now and is important. Acquired was 70% and you sold off 10%. So 70% less 10%, you're still remaining with 60%. So it's same a control to control situation, which means that when you are going to look at the solution of this, what you would expect to see, the cash in, that is what you would have expected to see, the cash in. And what would you have expected to see? You would have expected to see the increase in NCI. And how would you have done the increase in NCI? The same way we just did right now, the same way we did right now. The net assets or the net worth plus the goodwill, okay, and plus any fair value adjustments. And you would have taken a slice of it, or 10%. That would be the increase in NCI. When you check the solution for this, that's not how it was done. That's not how it was done. Why that's not how it was done? Because it was not a balance sheet question. It was a P&L question. Understand the cash in minus the increase in NCR that we do is for balance sheet. All the elements are balance sheet elements. Bank, balance sheet element, or the cash in is a balance sheet element. Increase in NCR is a balance sheet element. Movement in equity is a balance sheet element. This was a P&L sum. That's why you all did not see what is the regular formula for a control to control. Okay, where you have increase in NCA, what is the regular formula? That's why you did not see. Okay, because what happens is when you all are done with the Ashanti question, normally I get these text messages that why was this not done? Right? So before you all probably go through this, I want you all to bring in notice that why this is not done is because this is a P&L question. In P&L question, when you sell a slice, okay, and if it's a control to control situation, in the consolidated P&L, do you have any gain reporting? Do you have any gain reporting? No, you don't. You don't have the gain reporting. Okay, you don't have the gain reporting. So, what was done, I'm just giving you a brief of what was done in Ashanti. What was done in Ashanti was that they had identified what is the gain on disposal of these 10% shares that was taken in the single entity statement of Ashanti. That was taken in the single entity statement of Ashanti. So, if we would end up reading this question, it said that the 70% of the equity shares comprise the purchase consideration cash. So you made a cash payment of 140 million. And Ashanti elected to measure the investment at cost in its separate financial statement. So you know that even if it's 70% of acquisition in its separate financial statement, it's allowed to account for it in two ways: at cost, as an equity, or using financial instruments IFRS 9 treatment. Okay, so it chose to record it at cost. It chose to record this at cost. So in its individual financial statements, it's at this value. It's at cost. So when they talk about it being sold, so the selling price, the sale proceeds can be compared with this carrying value 10%. With this carrying value 10%. And whatever profit on disposal you have, this is the profit that was recorded in the single entity statement. When you're doing a consolidated statement, be careful that this profit should not be there. When you're consolidating it line by line, this was the calculation done in Ashanti, that this profit was figured out and this was explicitly removed then from the consolidated, because this must have been merged by a line by line activity. So this was removed. This is the adjustment that was done. Okay. So be clear with what was done. I'll read this. The draft consolidated statement of P&L and other comprehensive income has been prepared by aggregating the income and expenses of Ashanti Company and its subsidiaries on a line-by-line basis. Can you see a line-by-line adding has been done? And Ashanti Company's gain on disposal of shares in Bookham Company has been included within other income. So this is giving us the treatment that, oh, you know what? In single entity statement, in the other income, this income is present. What your job was as an adjustment to remove this, So for that, you had to find, okay, what were the sale proceeds? The sale proceeds for this 10% was 34 million. Okay. So I'll do this quickly now. In single entity or gain on disposal, recorded in single entity. Sale proceeds is a 34 million. Can you see this over here? 34 million. So 34 million less carrying value of 10% of net assets, which is 140 million. This 140 million into, by the way, this 140 million that you all have acquired, is it 100% of the company or 70% of the company? Put it in the chat box, 100% or 70%. You are paying this 140 million for 100% of the company or 70% of the company? Yeah, this payment of 140 million that you all have done is only for the 70% of the company. Okay, it's only for the 70% of the company. So when you're going to take a slice, when you want to take a slice of the 10%, should I do into 10 by 100 or should I do 140 into 10 by 70? What should I be doing? What is the right thing here? 10 by 70 or 10 by 100? 10 by 70, because if that 140 represents 70%, okay, 70%, then this should be 140 into 10 by 70. That's why when this was done, most of y'all also had this doubt that why 10 by 70? This 10 by 70 as a concept it comes only when you're acquiring more percentage of shares and NCI is decreasing as a result. In that scenario, we do a 10 by 70, not in this scenario. So you all had to understand this was actually a different scenario. This was not you know, a control to control normal balance sheet formula that we are using. No, this is what we're trying to identify, that what they have done in the single entity books. This is what they have done in the single entity books. Okay. Which is fine from a single entity perspective, no problem, but it's wrong from a consolidation perspective. So you're identifying this, and this is the gain on disposal recorded. The adjustment that would be required in your consolidated statement of P&L, in P&L from the other income, wherever that other income line was there, this was to be removed. Okay. It was to be removed from your other income. $160. Why would you say $160? It's $140, no? Comprised of the cash. You're saying because the fair value of the net identifiable assets is 160, right? Yeah, that is a valid question. Why not the fair value? Why are we taking this? Because in the single entity statement, they elected to measure it at cost. because of this word. They elected to measure it at cost. So if they're single entity books, it's elected at cost, which means it's recorded at cost. My measurement of the sale proceeds can only be with cost. Fair value is something that they have not recorded. So how do I do that then? How do I compare it with that? My concept is I have to identify what they recorded and then remove it from my consolidated statement, because in my consolidated statement that should not be there. So understand, it's a very different adjustment that we are doing. Sana, you understood why we are not taking 160? Because they did a election of recording at cost. Okay, anyone has a doubt still?
Yes, please repeat that portion.
Which portion, dear?
This portion.
Okay, the entire thing. Okay. Okay. So, guys, normally when you do a sale of share where it's a control to control situation, what do? You do cash in, you do less increase in NCI. And how do you do the increase in NCI? Percentage increase. So, if it's a percentage increase, so you take a 10 by 100 of the net assets. And if it's a full goodwill method, then plus goodwill also. And if there is any adjustment, then okay, this is how you do it. Your denominators by 100 versus this is when you're selling shares. And this is a control to control scenario. In control to control scenario, it can also be that you're purchasing shares, in which case it will be cash out and it will lead to decrease in NCI. So how do you do for your decrease in NCI? What is the decrease in NCI? Let's say it's a 10% decrease in NCI. Okay, it's a 10% decrease in NCI. So you check what is that existing NCI right now. Is it 30%, 40%? How much is that NCI? If that NCI is a 30%, then you do a 10 by 30 of the NCI value right now, right? Are you all able to recall this? Yes or no? Okay. So in this Ashanti scenario, you were selling shares and the calculation that has been done is sale proceeds compared with the carrying value of the 10% of NA net assets, where you have taken 1 by 140 into 10 by 70. You have not done it by 100. Okay, so this is where the confusion arises. You all start thinking that why by 70? That by 70 should come in case where we're purchasing shares, not selling shares. So understand the concept was totally different. One, this was not even a balance sheet calculation that we were doing. What is this? This is balance sheet calculation. We are trying to identify what is the positive or negative movement in the equity. Cash in, balance sheet. Increase in NCI, balance sheet. The movement that you will get, it will be a balance sheet movement. What we are doing in Ashanti is it's a control to control situation. It is selling of shares. But what we're identifying is what they have recorded in their profit and loss statement. This was a P&L sum. What they recorded in the P&L sum? They must have sold shares, so a gain or loss they must have recorded in the P&L, in the single entity, not in the consolidated. In the consolidated, to record a gain or loss is absolutely wrong. They recorded in the single entity a gain or loss, which is fine. What was the logic? How they must have recorded it? They recorded the sale proceeds minus the cost. So sale proceeds is 34 million, and how much is the cost or less the fair value? They chose to elect recording of that investment at cost only. At cost, they chose to elect it. So the cost is 140 for that 70% investment that you have. 140 for the 70% investment that you have. So you're going to take 10 by 70 of the 140, because that 140 represents 70, not 100. So when you compare it with that, you get the gain on disposal. And this gain on disposal from the consolidated statement of P&L, you'll have to remove, because what they did as an activity is a line by line adding of single entity statements. Single entity of parent and single entity of subsidiary. So when they did that line by line adding, taking this 14 was wrong, incorrect. So is why we removed it. Where it's wrong, in the consolidated statement, it's wrong. In the single entity, it's fine. This figure sitting in the single entity is fine, but in the consolidated, it's wrong, is why we have removed it. So Raghavina, Wasim, Nikita, have you all understood? Okay, fine. So now I will move from Ashanti to Banana Company, okay? No problem, dear. Banana has the fourth exhibit, which is the disposal of strawberry company. So, okay. Banana company purchased a 40% equity interest in strawberry company, so achieving significant influence for 18 million a number of years ago when the fair value of the identifiable net assets was 44 million. Banana company disposed of 75% of its 40% investment on 30th June 2007 for 19 million when the fair values of the identifiable net assets of strawberry were 50 million. So when it purchased it as a 40% and it achieved significant influence, what was this entity, strawberry to banana? What was this entity, strawberry to banana? What was strawberry to banana? It was an associate. Okay, it was an associate. So associate initially was purchased for 18 million. So starting point of this associate is 18 million. Then you will record the profits that are earned by this associate for equity accounting. What they gave us the equity or the fair value of the identifiable net assets for 44 million at acquisition date. And when it disposed of 75% of 40 for 19 million, the fair value of the identifiable net assets was 50 million. So when you dispose of the interest, you have the net assets is 50 million. So 50 million less your 44, you have the profit earned. So you will take a share in that. So you will know the carrying value of associate at the disposal date. How much are you disposing? 75% or 40% will be how much actually? It will be 30% disposed. It will be 30% disposed. For an entity to be an associate, what is the percentage? What is the percentage? For an entity to be an associate, how much percentage is considered as an associate relationship? 20 to 15. So from 40%, if you dispose 30%, if you're remaining with 10%, is it an associate anymore? Is it an associate anymore? No, it's not an associate. So you will have to do a disposal of this. You'll have to do a disposal of associate accordingly. So how would your process be? Now they're saying they're disposed it of for 19 million. So your sale proceeds. Logically, I'm trying to derive the formula, even if let's say you don't remember it memory wise. 19 million were proceeds. Okay. For what? For the 30% of it. And I will remove the carrying value of associate because associate has been disposed of. So how much is that associate? It was a 40% entity. And what would the carrying value be? 18 million plus 50 minus 44 plus 40% into 40%. How much is this? Can anyone quickly calculate and tell me how much is this coming to? 50 minus 44, that would be 6 million. 6 million into 40%. 2.4. So that would become 20.4, is it? 20.4, right? So you're comparing it with 20.4. Now, is this a like-to-like comparison to finding a gain on disposal? Are you doing or a loss on disposal? Are you doing a like-to-like comparison? You're comparing 30% of proceeds of 30% with a 40% carrying value. Is this a like-to-like comparison? Yes or no? No. So this is not a like-to-like comparison that you're doing. 19 million compared with a less 20.4 is not a like-to-like. So what is this remaining 10%? Fair value of the remaining 10%. Yes. So the increase in net assets is attributable to profits. Fine. The fair value of the remaining 10% interest in equity was 4.9% at disposal. Okay. So fair value of remaining interest is 4.9. So when you do this, then you will get the gain or loss on disposal of associate. So whatever this is, you will get it. But this is how you will do it. And then I will read what wrong they have done. But till here, anyone has a doubt logically of what I'm doing? Okay, if it's coming 3.5 million, great. I'll read further also, no problem. And then we'll do again on the Excel, double. Because I know you all will want double, one time here, one time in the Excel. Okay. Now, in its separate financial statements, Banana Company has recorded a profit of disposal of 55.5 million on disposal. We are getting 3.5. They have recorded it as 5.5. calculated as the difference between 75% of the 18 million cost of investment and the proceeds of 19 million. So how they got this 5.5 million? They're doing a very simple comparison. They're doing a 19 million comparison, which is we also took, with 75% of 18 million. So they are just considering cost comparison. They are not removing the entire associate value, which is the carrying value. They're not considering the fair value. Why? Because in the single entity, okay. So achieving significant disposed of for the increase in separate financial statements. Okay. So in separate financial statements, for once, this is okay because they're allowed to record it at cost also. So if they've done this, it's fine. In consolidated statements, would this be right? In consolidated statement, are you allowed to record the associated cost? Would this be right? Comparing 19 with a 75% of 18 million, would this be right? No, it would be wrong. I'll repeat, Raghavina. In the single entity statement, they did a very simple comparison. What they did, Raghavina, did you understand the formula that I've put up right now first? The sale proceeds, 10% of the shares, 40% associate. Yeah, this you understood. So you are understanding that this is actually the gain on disposal that will sit in my consolidated statement of financial position. Why? Because in my consolidated statement of financial position, I will be doing equity accounting. And equity accounting meaning the associate's value will be this as per equity accounting. You just saw here, right? Now, what they did in their single entity statement is a very simple calculation. They compared the 19 million proceeds, which we also took, with the 75% of 18 million, the cost. Can you see the original cost was 18 million? The original cost. They're just comparing it with the original cost 75%. They're not even considering the share of profit that it earned because that's fine. In single entity, they are allowed to take it at cost. They can elect to record it at cost. So it's okay. In single entity, it's not wrong. Sana, they are rather. Oh, you're saying carrying value? No, Sana, they're allowed to do three types of treatment for associate. They can elect it at cost. They can elect it to record it at as using equity accounting, which is what we have to do compulsory in consolidated financial statements. Third, they're also allowed to use IFRS 9 financial instruments. Okay, so they did at cost, which is fine. But what we have to do is we have to identify what is the right treatment for consolidated and pass entry accordingly. So this is the right thing and we have to pass entry it accordingly. Okay, so I'll do this quickly again on your Excel. So a repeat will anyway naturally happen for anyone who did not understand. Okay, I have sale proceeds. I'll compare it with the carrying value of associate. So how do I find the carrying value of associate? I'm getting into a little detail. Sorry, it'll keep the main formula up and this will act as a working. Okay. Carrying value of associate would be cost of investment and share in profits. Cost of investment was 18 million. Share in profit is 50 less 40. Okay. So sale proceeds minus carrying value of associate. And I will also have to consider the fair value of existing investment. So sale proceeds being 19 million. Fair value of existing investments being 4.9 million. And carrying value of the associate, I just did a calculation for it. So this is my gain on disposal of associate. So if I have to go and correct it in my pre-populated, the correcting JE that will come in picture is JE or journal entry or JV, whatever you want to call it. Sale proceeds would mean debit bank, 19, right? Um, Credit gain, 3.5. Okay. Then you have your fair value of existing investment. So you would want your investment to be recorded at 4.9. And then you would have the associate going out of your books. So credit associate. It's going out of your books at 20.4. You check the debits are 23.9 and the credits are also 23.9. Why wrong disposal? I didn't understand. Why wrong disposal, dear? This is the right thing, no? This is the gain on disposal. That's the right disposal from a consolidated statement. So this should be visible in my consolidated financial statements. That is sitting in the single entity statement. So that's okay. That's sitting in the single entity statement, not in your consolidated statement. Okay. So yes, with this, we come to an end to our session on disposal as well. Like I said, yesterday and today was just purely consolidation, but I know that there is release of content by the ACCA body where you have amalgamation questions now. So definitely I'll want to probably run through it with me. So like I said, I will be covering it, but when I will not reveal, but it will be covered in the revision week. Don't worry. And yeah, next session would be practice session 7. You all have finished 6 regular sessions. So next session would be a 7th practice session. And yes, there's some material that I want to cover. It will be additional material or maybe a question practice. I'll let you all know on the day, depending upon the priority of what I want to give. Like there are some things I would want to keep in mock, some things I would want to keep in the 7th practice session that I'm still deciding. So anyway, seventh practice session will be accordingly. But anyway, it will be an important session. So I will request everyone to make sure you all are attending. If not attending, no problem. Make sure you're watching the recording at least. Also, those who missed the recording of yesterday, please watch the recording.
Hi, ma'am. I just wanted to confirm, when can we get the recording?
Ideally they do post the recording next day, but this is going to get uploaded on YouTube. So I feel like they might not work on weekend. 15th it could, but if it is not getting uploaded by 15th, then the only next time it's possible is by 17th they will upload it because they don't work on Sundays for sure. It could get uploaded by tomorrow. If not by tomorrow, then it's going to be Monday, 17th.
Okay, thank you.
No problem.
Hello, ma'am.
Yep. Yes, dear.
Will it be Woodfleet sum? Tomorrow we have the practice session. It's so.
Tomorrow, no. Tomorrow we don't have a practice session.
When we are there having that practice session 7?
No, tomorrow there is no session. One second. Even if tomorrow there is, I'll have to cancel it. I'm flying tomorrow out of the country.
Said there's a practice session 7 for which is what is the timings regarding that?
1 second, dear. 1 second. No, there's nothing on the 15th. There's nothing on the 16th. This the direct practice session is on the 17th, and I will share the timing, but I will not be able to share the timing right now. Like I said, I'm traveling, so there are a lot of changes that's going to happen in terms of how things are in the coming week for me. Anyway, I will share it. Don't worry. At least I'll make sure it's shared 24 hours prior, and it's a practice session. It's not this long. It's just a 1 hour session. If y'all miss it also because y'all couldn't take a leave from work, whatever reason, it's okay. It's a practice session. Anyway, what I've done is I'm at least trying to stick to the dates because you all requested that leaves have been taken accordingly. Otherwise, 17th was not convenient. All these webinars and everything, I wanted to pull much behind and finish it earlier. But at least I'm trying to stick to the dates. Timing, I will share. Give me time, I will share it. 21st prior. Yeah, there is a pre-mock. One is 50 mark. That will only be discussed or debrief with me. That will not be checked. And then there is a 100 mark mock, which will be discussed and checked by me both. 17th. It's on 17th, Pramati. Next class is on 17th. Yes, it's 17th. Okay. Fine. Thank you, everyone. Have a good day. Bye bye, everyone. Thank you.